Mortgage rates just hit their lowest level since April. So, what's behind the drop? How much does the Fed really influence your mortgage? And could this signal a new trend for the housing market? I'm Johannes, and here to break it all down is Matthew Johannes, head of agency MBS Structured Product Trading at StoneX. Welcome, Matthew. Thank you so much for your time.
Hey, thanks for having me.
So, U.S. mortgage rates are down. That's great for home buyers. But what's behind this recent drop?
Yeah. So, the real question I don't think necessarily is what's driving mortgage rates lower versus what's actually driving interest rates in the U.S. lower at this point. U.S. mortgage rates have a very strong correlation to the 10-year Treasury. And in the last basically 2 weeks, we've moved lower basically 20 basis points in the 10-year yields. That's coming from a couple different factors. In general, the Fed's been pretty transparent that they're watching the labor markets and watching the inflation markets. And Friday, we had a very weak non-farm payroll number with around only 22,000 jobs added in the month of August. That's also upticked unemployment to around 4.3%, which I think underscores the cooling labor market in the U.S., which probably clears the path for rate cuts in September and maybe potentially another rate cut sometime this year.
So you just mentioned the Fed, actually, and at the September FOMC meeting, Powell did signal a possible cut. So does the Federal Reserve play a role in shaping mortgage rates?
Yeah, so the Fed doesn't directly dictate mortgage rates, but some of their monetary policies and tools will have a direct impact on mortgage rates. There's really two that we're the most familiar with since the COVID periods. Fed funds rates and what they imply short-term borrowing rates are at, as well as their balance sheet and their utilization of whether outright buying or reinvesting the paydowns. The first one I would attack is, Fed funds, which, everyone's very familiar with, but the driver of mortgage rates versus Fed funds isn't necessarily directly correlated. It's more the fact that the yield curve is likely moving lower across the board, but it also makes the investor base who buys mortgage-backed securities that much more interested in the product. And what I mean by that is when Fed funds goes lower, it tends, in this current environment, we're both steepening, right?
Yeah.
Front end of the curve is moving faster than the long end of the curve is moving down. That's making a lot of these levered investors, so such as like a REIT who borrows short term and invests long term to collect the spread between mortgages and U.S. Treasuries, more interest in the product. So we're seeing a lot of heavy REIT demand. Banks are the same way, right? They're borrowing short and investing long, whether they're investing through mortgage-backed securities or making loan rates. But that ultimately, drives mortgage spreads between mortgages and U.S. Treasuries tighter, which ultimately brings mortgage rates lower in the U.S. We've seen periods of low interest rates in the last year and a half, lower than we are now in the 10-year note, but mortgage rates struggled to really break through that 6% yield or 6.25% loan rate. And a lot of those factors have to do with the front end and the curve.
So what has been the impact then from the drop in mortgage rates on the housing market right now?
Yeah, so this is one of those scenarios where I would say, only time will tell, right? The Freddie Mac survey rate had mortgage rates around 6.9% a couple months ago, and now they're saying they're around 6.67%. That savings on, say, a $500,000 mortgage is only about $100 per month with that kind of change. I don't know that that's directly making housing that much more affordable in the U.S. with that type of move. What we need to start seeing is now mortgage rates making a meaningful step lower. So if you start seeing, sub 6% mortgage rates, that will really kind of start to, I think, increase the demand for housing in the U.S. And, we are in the last couple of days in our seat, we see some of the mortgage origination volume. We are seeing originators starting to offer some of these lower rates. We've been hearing sub 5 3/4 interest rates on mortgages, and that's a significant jump lower than we've seen, just in the survey rate.
Which, like I said earlier, it's hugely helpful for home buyers. So what else is being affected by this drop, though, aside from obviously helping home buyers?
Yeah, in general, when you see interest rates take a leg lower like this, it brings the negative convexity aspect into the mortgage market, right? Refinance activity we would expect to really start to ramp up. We always heard this line where a lot of people over the last 2 years who were buying homes were, marrying the home and dating the rate, right? So the thought was to buy the house to potentially refinance in the future. we're kind of getting to that spot now where maybe some of the stuff is refinanceable. And if that's the case, you're going to see a pretty negative impact on some of the higher coupons in the mortgage world, which naturally creates a demand for whether investors, for money managers, banks, REITs to buy more duration. So they start to throw fire on the rally in some ways by having to buy more duration back as their portfolios shorten. So in general, that's probably something that we saw since Friday's non-farm number, but we'll continue to monitor. If we move sub 4% in the 10-year note, I think that it has to happen again and people have to start buying more. So it's a self-fulfilling prophecy in some ways, to where as we start to rally, it can really rally hard. So
let's see. Thank you, Matthew, for your time. And thank you for watching. For more financial content, don't forget to like and subscribe to our channel.